The information provided by Michael Beebe and this channel is for educational and informational purposes only. Michael Beebe is not a licensed financial advisor or investment professional. The content presented does not constitute financial, investment, or legal advice. Before making any financial decisions, it is strongly recommended that you seek advice from a qualified financial advisor or investment professional who can provide personalized guidance based on your individual circumstances. Investing in cryptocurrencies and other financial instruments involves significant risk and may not be suitable for all investors. Past performance is not indicative of future results, and there is no guarantee that any investment strategy will achieve its objectives. Michael Beebe and this channel are not responsible for any losses or damages arising from the use of this information or from any decisions made based on the content provided. Always conduct your own research and consider your financial situation, risk tolerance, and investment goals before making any investment decisions. Part 1.
BlackRock, a name that echoes power and influence across the financial world. As one of the globe's largest asset management firms, BlackRock has a staggering $10 trillion under its watchful eye. It's a titan in the world of finance, shaping markets and guiding the portfolios of millions. But what happens when a giant like BlackRock steps into the volatile and often unpredictable world of cryptocurrency? Recently, BlackRock made headlines with a bold move, an investment of $1 billion into Bitcoin. This isn't just another drop in the ocean, it's a seismic shift that could send ripples across the entire financial landscape. For years, Bitcoin was seen as the wild child of finance, a speculative asset known for its dramatic highs and lows. Now, with BlackRock's endorsement, the world is paying attention like never before. But what does this mean for you, the investor? Is this the beginning of a new era for Bitcoin, or just another chapter in its roller coaster journey? In this documentary, we'll delve into the details of BlackRock's monumental investment and what it signifies for the future of both cryptocurrency and traditional finance. We'll explore the implications for the broader market and, more importantly, what this could mean for your own financial strategy. As we unravel the story behind BlackRock's $1 billion commitment to Bitcoin, we'll uncover how this single decision could influence the way you think about investing in the years to come. Join us as we take a closer look at this historic moment and what it means for investors around the world.
Part 2.
To understand the gravity of BlackRock's recent investment in Bitcoin, we first need to understand BlackRock itself, a behemoth in the world of finance. Founded in 1988 by Larry Fink and a small team of partners, BlackRock began as a modest risk management and fixed income institution. But what started as a small operation quickly evolved into something much larger. Through a combination of strategic acquisitions, technological innovation, and a keen eye for market trends, BlackRock grew into the world's largest asset manager, overseeing an astonishing $10 trillion in assets. BlackRock's rise to power wasn't just about growing its portfolio. The firm became synonymous with financial expertise and reliability. It pioneered the use of data-driven investment strategies, leveraging technology to assess risks and optimize returns in ways that had never been done before. This innovative approach, coupled with a relentless focus on client needs, allowed BlackRock to expand its reach across the globe, managing the wealth of individuals, corporations, and governments alike. But what truly sets BlackRock apart is its investment philosophy. At the core of its strategy is a commitment to diversification and risk management. BlackRock's approach is rooted in the belief that a well-diversified portfolio can weather even the most turbulent of markets. This philosophy is reflected in the firm's extensive range of investment products, from traditional stocks and bonds to more complex financial instruments. BlackRock doesn't just invest in assets, it shapes them. The firm is known for its long-term outlook, often holding on to investments for years or even decades, a strategy that has proven successful time and again. BlackRock's investment decisions are meticulously calculated, supported by cutting-edge analytics and a deep understanding of global markets. This allows the firm to not only generate strong returns for its clients, but also to influence entire sectors of the economy. And then there's BlackRock's influence on the global stage. With its massive scale and reach, BlackRock doesn't just participate in markets, it helps define them. When BlackRock makes a move, the world takes notice. The firm's decisions can sway market trends, impact corporate policies, and even shape government regulations. BlackRock's role as a trendsetter in investment is unparalleled. Its actions often serve as a bellwether for the broader financial industry. In fact, BlackRock's influence is so profound that it has earned the nickname the fourth branch of government due to its close ties with policymakers and its involvement in critical economic decisions. Whether through its advisory roles or its investment choices, BlackRock has a hand in shaping the future of the global economy. So when a firm with this level of power and influence decides to invest $1 billion in Bitcoin, it's not just another trade, it's a statement. It signals a shift in how the world's financial elites view cryptocurrency. It suggests that Bitcoin, once dismissed as a fringe asset, is now being taken seriously by the very institutions that define the world of finance. Understanding BlackRock's history, philosophy, and influence helps us grasp the full significance of this move. It's not just about a single investment, it's about the broader implications for the financial world and what it could mean for the future of money itself. As we continue our exploration, we'll see how this decision might reshape not only the cryptocurrency market but also the strategies of investors worldwide.
Part 3.
Before we delve into the implications of BlackRock's monumental investment, it's crucial to understand the landscape of Bitcoin before this move, a landscape defined by innovation, volatility, and growing institutional curiosity. Bitcoin was born in 2009, the brainchild of an anonymous figure, or group, known as Satoshi Nakamoto. In the aftermath of the 2008 financial crisis, Bitcoin was introduced as a decentralized digital currency, one that operated independently of any government or financial institution. The idea was revolutionary, a peer-to-peer network that allowed for secure, transparent, and irreversible transactions without the need for intermediaries. Bitcoin wasn't just a new currency, it was a new way of thinking about money and value. In its early years, Bitcoin was largely a niche curiosity, embraced by a small but passionate community of technologists and libertarians. It was a digital experiment, often misunderstood and dismissed by mainstream finance. But as time went on, Bitcoin began to gain traction. It weathered cycles of boom and bust, attracting attention with its dramatic price swings and the promise of outsized returns. Key milestones marked Bitcoin's evolution. In 2010, the first real-world Bitcoin transaction occurred. A man in Florida paid 10,000 Bitcoins for 2 pizzas, a sum worth hundreds of millions today. This moment symbolized Bitcoin's potential as a medium of exchange. Over the next few years, Bitcoin saw its value skyrocket, from pennies to thousands of dollars per coin. The rise of exchanges like Mt. and later Coinbase made it easier for the average person to buy, sell, and trade Bitcoin, further fueling its popularity. But with this rapid rise came significant challenges. Bitcoin's reputation as a speculative asset became cemented, with prices often fluctuating wildly. The infamous crash of 2017, where Bitcoin's price plummeted from nearly $20,000 to around $3,000, highlighted the risks involved. Critics were quick to label Bitcoin as a bubble, a digital tulip mania that was bound to burst. Yet, despite these setbacks, Bitcoin endured, continually bouncing back, driven by its growing user base and increasing acceptance as a legitimate form of payment. As Bitcoin evolved, so did the market's perception of it. Initially, it was seen as a playground for speculators and those looking to make a quick buck. Its association with dark web marketplaces and cybercrime further tarnished its image. But beneath the surface, a shift was occurring. Bitcoin's underlying technology, blockchain, was proving to be a game-changer, offering unprecedented security, transparency, and efficiency in transactions. This began to catch the attention of more serious players, institutions that were beginning to see Bitcoin not just as a risky bet, but as a potential hedge against traditional financial markets. This shift in perception was subtle at first, with a few pioneering firms and high-net-worth individuals dipping their toes into the crypto waters. Companies like MicroStrategy and Tesla made headlines with their substantial Bitcoin acquisitions, signaling a change in the winds. Hedge funds, once wary of Bitcoin's volatility, started exploring it as a way to diversify portfolios. The idea that Bitcoin could serve as a digital gold, a store of value in times of economic uncertainty, began to take hold. As institutional interest in Bitcoin grew, so did the infrastructure supporting it. Custodial services, regulated exchanges, and the development of financial products like Bitcoin futures and ETFs began to emerge, making it easier for traditional investors to gain exposure to the cryptocurrency. This period also saw a surge in educational efforts, as financial institutions and analysts began to take a closer look at what Bitcoin had to offer. By the time BlackRock made its $1 billion commitment, the stage was already set. Bitcoin had transformed from a fringe experiment into a viable asset class, one that was increasingly being integrated into the global financial system. BlackRock's investment wasn't just a leap into the unknown, it was a calculated move into a market that had been steadily gaining legitimacy and momentum. Understanding this context, the history, the volatility, and the growing institutional interest, helps us appreciate the significance of BlackRock's decision. Bitcoin's journey from a cryptographic curiosity to a cornerstone of modern finance is nothing short of remarkable, and with BlackRock now in the mix, this journey is far from over.
Part 4.
BlackRock's decision to invest $1 billion in Bitcoin wasn't made lightly. As the world's largest asset manager, BlackRock is known for its meticulous, data-driven approach to investment. Every move it makes is carefully calculated, informed by extensive research, and executed with precision. So, what led BlackRock to take this significant step into the world of cryptocurrency, and why now? The decision to invest $1 billion in Bitcoin was the culmination of a series of internal discussions and analyses within BlackRock. The firm had been monitoring the cryptocurrency space for years, observing its growth, volatility, and increasing acceptance. As Bitcoin evolved from a speculative asset into something more stable and widely recognized, BlackRock's leadership began to see potential that couldn't be ignored. The company's chief investment officer, Rick Rieder, had already hinted at Bitcoin's potential as early as 2020, suggesting that it could become a permanent fixture in the global financial landscape. In 2024, with the cryptocurrency market maturing and institutional interest reaching new heights, BlackRock made its move. The firm decided to allocate $1 billion to Bitcoin, marking one of the most significant investments in the asset by a major financial institution. This wasn't just a bold statement, it was a clear signal to the world that BlackRock saw Bitcoin as more than just a speculative gamble, it was a strategic asset worthy of inclusion in its vast portfolio. But why now? The timing of BlackRock's investment is crucial to understanding its significance. In the years leading up to this decision, the global financial landscape had been undergoing profound changes. The COVID-19 pandemic had shaken markets, driving investors to seek new avenues for growth and stability. Central banks around the world were printing money at unprecedented rates, leading to concerns about inflation and the devaluation of traditional currencies. Amidst this uncertainty, Bitcoin began to emerge as a potential hedge, a digital asset that, like gold, could offer protection against inflation and economic instability. By 2024, Bitcoin had weathered several market cycles and proven its resilience. Its price, though still volatile, had reached new heights, and the infrastructure around it had grown significantly. Custodial services, regulated exchanges, and Bitcoin-based financial products had made it easier for institutions to invest with confidence. The timing was right for a major player like BlackRock to enter the market. BlackRock's investment was also influenced by broader market conditions. The firm recognized that the global economy was in a state of flux, with traditional assets facing new challenges and uncertainties. In this environment, Bitcoin's decentralized nature and finite supply made it an attractive alternative to fiat currencies and even to traditional assets like bonds. BlackRock's leadership saw an opportunity to diversify its portfolio with an asset that wasn't just another currency, but a potential store of value and a hedge against inflation. The strategic rationale behind BlackRock's investment goes beyond mere diversification. By allocating $1 billion to Bitcoin, BlackRock is not only betting on the future of cryptocurrency but also positioning itself at the forefront of a financial revolution. The firm sees Bitcoin as a valuable addition to its portfolio, not just for its potential returns, but for what it represents, a new era in finance, where digital assets play a central role in global markets. BlackRock's decision is also a recognition of Bitcoin's growing legitimacy. The firm understands that as more institutions adopt Bitcoin, its stability and acceptance will only increase. By investing now, BlackRock is not just following the trend, it's helping to shape it. The company's involvement is likely to encourage other institutions to follow suit, further integrating Bitcoin into the fabric of global finance. In essence, BlackRock's $1 billion investment in Bitcoin is a strategic move that reflects the company's forward-thinking approach to finance. It's a calculated bet on the future, one that acknowledges the changing dynamics of the global economy and the growing importance of digital assets. As BlackRock steps into the world of cryptocurrency, it's not just investing in Bitcoin, it's investing in the future of money itself. This decision, this timing, and this rationale all point to one thing: BlackRock sees Bitcoin as more than just an asset. It sees it as a pivotal part of the financial landscape of tomorrow, one that offers both challenges and opportunities for investors worldwide. As we continue our exploration, we'll examine the broader implications of this move and what it could mean for the market, the economy, and your own investment strategy.
Part 5.
The implications of BlackRock's $1 billion investment in Bitcoin have reverberated across the cryptocurrency market, sparking reactions and raising questions about what this means for the future of digital assets. The market's reaction to BlackRock's announcement was immediate and significant. As news of the investment broke, Bitcoin's price surged, reflecting the confidence that the world's largest asset manager was now backing the digital currency. This wasn't just a typical price rally, it was a market affirmation. The endorsement from a financial titan like BlackRock sent a clear signal to investors: Bitcoin is no longer just a speculative asset on the fringe, it's a serious player in the global financial system. Traders, analysts, and investors quickly adjusted their outlooks, recognizing that BlackRock's involvement could mark a turning point for Bitcoin. The influx of capital from such a respected institution brought a new level of credibility to the cryptocurrency, driving optimism in the market. Other cryptocurrencies, often influenced by Bitcoin's performance, also saw increased activity, as the entire digital asset space felt the ripple effects of BlackRock's move. But beyond the immediate market reaction, BlackRock's investment has had deeper implications for Bitcoin's legitimacy as a mainstream asset. For years, Bitcoin has struggled to shed its image as a volatile, speculative instrument, largely unregulated and viewed with skepticism by traditional finance. While it has gained acceptance as a store of value, it has remained a polarizing asset, often associated with high risks and uncertainty. BlackRock's entry into the Bitcoin market changes that narrative. The firm's rigorous due diligence and risk management practices are well known, and its decision to allocate such a substantial sum to Bitcoin serves as a powerful endorsement. BlackRock's involvement suggests that Bitcoin has matured beyond its early days of volatility and speculation. It indicates that Bitcoin is now seen as a viable asset class, worthy of consideration alongside more traditional investments like stocks, bonds, and real estate. This increased legitimacy could have far-reaching consequences. With BlackRock now on board, we're likely to see other major financial institutions reevaluating their stance on Bitcoin. The precedent set by BlackRock could inspire a wave of institutional investment, as other firms look to capitalize on the opportunities presented by Bitcoin. The domino effect could lead to a significant influx of institutional capital into the cryptocurrency market, further stabilizing prices and integrating Bitcoin into the broader financial ecosystem. Moreover, as more institutions follow BlackRock's lead, we could see increased regulatory scrutiny and the development of new financial products centered around Bitcoin. This might include more Bitcoin ETFs, futures contracts, and other derivatives, making it easier for institutional and retail investors alike to gain exposure to the cryptocurrency. The infrastructure supporting Bitcoin will likely continue to evolve, becoming more robust and secure, which in turn could attract even more investment. The potential for increased institutional involvement doesn't just affect Bitcoin, it has implications for the entire cryptocurrency market. As institutions pour money into Bitcoin, they may also start exploring other digital assets, driving interest and investment across the board. This could lead to the growth of a more diverse and mature cryptocurrency market, where a range of assets are traded and utilized for various purposes, from decentralized finance to digital payments. However, this increased attention from institutions and regulators could also bring challenges. As Bitcoin becomes more integrated into the financial system, it may face new forms of regulation that could impact its decentralized nature. The balance between fostering innovation and ensuring stability will be a key issue for the future of Bitcoin and other cryptocurrencies. In the end, BlackRock's $1 billion investment is more than just a financial decision, it's a watershed moment for the cryptocurrency market. It marks a shift in how Bitcoin is perceived, from a fringe asset to a cornerstone of modern finance. The ripple effects of this move are already being felt, and as the dust settles, the landscape of the cryptocurrency market may be forever changed. For investors, both institutional and individual, the message is clear: Bitcoin is no longer something to be ignored. It's an asset that commands attention, respect, and careful consideration. Whether you're a seasoned investor or someone just beginning to explore the world of digital assets, BlackRock's investment serves as a powerful reminder that the future of finance is being written in code, and Bitcoin is at the forefront of this transformation.
Part 6.
BlackRock's $1 billion investment in Bitcoin is not just a landmark event for the cryptocurrency market, it's also likely to have profound implications for traditional investors and how they approach their portfolios. As the financial landscape shifts, we need to consider how this move might influence investment strategies and what it means for those looking to diversify their holdings. One of the primary ways BlackRock's investment could impact traditional investors is by encouraging them to explore cryptocurrencies as a viable asset class. For years, cryptocurrencies have been largely relegated to the domain of speculative trading, often dismissed by traditional finance as a high-risk gamble. But with a major player like BlackRock now making a substantial investment, the narrative is shifting. Portfolio diversification is a fundamental principle of investing, aimed at spreading risk across various asset classes to enhance stability and potential returns. Traditionally, this has involved mixing stocks, bonds, and real estate. Now, with cryptocurrencies gaining mainstream acceptance, they are becoming an increasingly attractive option for diversification. Bitcoin, in particular, is being viewed as a potential hedge against traditional market risks, such as inflation and currency devaluation. As a result, traditional investors may start considering cryptocurrencies not just as speculative ventures, but as integral parts of a balanced investment portfolio. However, integrating cryptocurrencies into a traditional investment strategy is not without its challenges. The volatility associated with Bitcoin and other digital assets remains a significant concern. While the potential rewards are substantial, the risks are equally pronounced. Bitcoin's price history is marked by dramatic swings, with periods of rapid appreciation followed by sharp declines. This inherent volatility can lead to substantial gains, but it also carries the risk of significant losses. For individual investors, this means a careful assessment of their risk tolerance and investment goals. BlackRock's endorsement lends credibility to Bitcoin, but it doesn't eliminate the risks associated with investing in cryptocurrencies. Investors need to weigh the potential for high returns against the possibility of market turbulence. This requires a nuanced understanding of how digital assets fit into their overall investment strategy and how they align with their financial objectives. Despite these risks, the long-term outlook for Bitcoin, especially with institutional backing, is attracting considerable interest. Experts are increasingly optimistic about the role of Bitcoin in the future of finance. The growing acceptance by major institutions is seen as a sign of Bitcoin's maturing status and its potential for long-term value. Institutional investment often brings a degree of stability and legitimacy to an asset, and BlackRock's involvement is likely to reinforce the perception of Bitcoin as a serious investment opportunity. In the long term, Bitcoin's potential is often compared to that of other transformative technologies. Just as the Internet revolutionized communication and commerce, Bitcoin and blockchain technology have the potential to reshape the financial landscape. Experts point to Bitcoin's scarcity, its limited supply of 21 million coins, as a key factor that could drive its value higher over time. As more investors and institutions recognize Bitcoin's role as a store of value, akin to digital gold, its long-term prospects could become even more promising. The increased institutional interest could also spur further innovations and developments in the cryptocurrency space. This might include more sophisticated financial products, better regulatory frameworks, and enhanced security measures, all of which could contribute to a more stable and accessible market for traditional investors. For those considering Bitcoin as a long-term investment, it's essential to stay informed and be prepared for both opportunities and challenges. The landscape is evolving, and as Bitcoin becomes more integrated into the financial system, its role in investment portfolios will likely become more defined. In summary, BlackRock's investment in Bitcoin marks a significant moment in the intersection of traditional finance and digital assets. For traditional investors, it signals an evolving opportunity to diversify and potentially enhance their portfolios. While the risks are real and must be carefully managed, the long-term potential of Bitcoin, bolstered by institutional support, suggests that cryptocurrencies are becoming an increasingly important component of modern investment strategies. As this new chapter unfolds, investors will need to navigate the complexities of this emerging market, balancing risk and reward as they chart their investment paths in a rapidly changing financial world.
Part 7.
BlackRock's monumental investment in Bitcoin not only marks a turning point for the cryptocurrency market but also sets the stage for broader economic and regulatory shifts. As we navigate this new terrain, it's essential to understand how such a significant move might influence global regulations, economic dynamics, and the development of new financial products. First, let's explore the regulatory landscape. Historically, the cryptocurrency market has been characterized by a lack of consistent global regulations. Different countries have adopted varying approaches to digital assets, ranging from outright bans to full integration into the financial system. BlackRock's entry into the Bitcoin market is likely to amplify the push for clearer and more cohesive regulatory frameworks. With a major financial institution backing Bitcoin, regulators around the world may feel increased pressure to address the regulatory gaps and uncertainties that have long surrounded cryptocurrencies. This could lead to more stringent regulations aimed at safeguarding investors and ensuring market stability. Governments might introduce measures to prevent market manipulation, enhance transparency, and protect consumers. Conversely, clearer regulations could also foster a more favorable environment for innovation and investment, potentially leading to increased institutional participation in the cryptocurrency space. As regulations evolve, they could also impact how cryptocurrencies are integrated into the broader financial system. For instance, enhanced regulatory clarity might encourage more financial institutions to explore cryptocurrency investments, leading to a more structured and stable market. This shift could also prompt governments to develop frameworks that support the safe and secure use of digital assets while mitigating associated risks. Turning to the economic impacts, the presence of large-scale institutional investments in cryptocurrencies like Bitcoin signifies a major shift in economic dynamics. When substantial capital flows into digital assets, it can influence various aspects of the economy, including market stability and liquidity. Institutional investments can bring a level of maturity and credibility to the cryptocurrency market, potentially reducing volatility and fostering a more stable investment environment. Additionally, the economic implications of such investments extend beyond just the asset prices. The increased interest from institutional investors can drive innovation in the financial sector, as firms develop new technologies and solutions to accommodate digital assets. This can lead to job creation, advancements in blockchain technology, and the growth of ancillary services related to cryptocurrencies. Moreover, the influx of institutional capital can enhance market depth and liquidity, making it easier for other investors to buy and sell cryptocurrencies. This increased liquidity can help stabilize prices and reduce the impact of large transactions on market volatility. For the broader economy, this stability can translate into a more predictable investment environment, potentially encouraging more widespread adoption of digital assets. Looking ahead, one of the most exciting prospects is the development of Bitcoin-related financial products, such as ETFs and other investment vehicles. BlackRock's investment could pave the way for the introduction of Bitcoin ETFs, exchange-traded funds that would allow investors to gain exposure to Bitcoin without directly owning the asset. The approval and launch of such products would represent a significant milestone, making Bitcoin more accessible to average investors who may not have the expertise or resources to navigate the cryptocurrency market directly. These financial products could also help bridge the gap between traditional finance and the world of digital assets. They would offer a regulated and familiar investment vehicle for those looking to diversify their portfolios with Bitcoin, while also providing a way to manage risk more effectively. The development of Bitcoin ETFs and other related products could lead to increased institutional investment, further legitimizing Bitcoin and potentially driving its price higher. In conclusion, BlackRock's $1 billion commitment to Bitcoin is more than just a financial maneuver, it's a catalyst for change in both regulatory and economic realms. As regulators respond to the growing influence of cryptocurrencies, we can expect to see clearer regulations that shape the future of digital assets. At the same time, the economic impact of institutional investments will likely drive innovation, enhance market stability, and foster the development of new financial products. For average investors, the future promises greater access to Bitcoin through a variety of investment vehicles, making it easier than ever to participate in this transformative financial landscape. As we continue to monitor these developments, it's clear that the intersection of traditional finance and cryptocurrency is evolving rapidly, with BlackRock's investment serving as a pivotal moment in this ongoing evolution.
Part 8.
While BlackRock's $1 billion investment in Bitcoin is a significant milestone, it also raises important questions about the broader cryptocurrency market and the potential for other digital assets. Bitcoin may be the focal point, but the cryptocurrency space is diverse, encompassing numerous coins and tokens, each with unique attributes and potential. So what is the impact on other cryptocurrencies? Increased institutional interest in altcoins. BlackRock's substantial commitment to Bitcoin could pave the way for increased institutional interest in other cryptocurrencies. As Bitcoin gains credibility with major institutional backing, other prominent digital assets such as Ethereum, Binance Coin, and Cardano might also see a surge in attention. These altcoins, each with their own technological innovations and use cases, could become more attractive to investors looking to diversify their portfolios beyond Bitcoin. Institutions may start to explore these alternatives, leading to broader market participation. Market dynamics and diversification. The ripple effects of BlackRock's investment could lead to shifts in market dynamics. With Bitcoin gaining mainstream recognition, other cryptocurrencies might benefit from increased visibility and legitimacy. This could foster a more dynamic market environment where various digital assets are evaluated not just as speculative investments, but as integral components of a diversified digital asset portfolio. Investors might seek opportunities in other cryptocurrencies that offer unique value propositions, such as decentralized finance, DeFi, platforms or blockchain-based solutions for specific industries. Development of financial products. The growing institutional interest in cryptocurrencies might also lead to the development of new financial products related to a wider range of digital assets. Just as Bitcoin ETFs and other investment vehicles are being explored, similar products could emerge for other major cryptocurrencies. This could make it easier for both institutional and retail investors to gain exposure to a broader spectrum of digital assets, enhancing their ability to participate in and benefit from the cryptocurrency market. Potential for innovation and collaboration. The rise in institutional investment could stimulate innovation within the cryptocurrency space. With more resources and attention directed towards digital assets, we might see accelerated development in blockchain technology and new use cases for various cryptocurrencies. Additionally, collaboration between traditional financial institutions and cryptocurrency projects could lead to the creation of novel financial solutions, further integrating digital assets into the mainstream financial system. While BlackRock's investment in Bitcoin is a landmark event, it also sets the stage for broader changes across the cryptocurrency market. The increased legitimacy and institutional interest in Bitcoin could extend to other digital assets, fostering a more diverse and innovative market. As the landscape evolves, investors and institutions alike will have the opportunity to explore and engage with a wide range of cryptocurrencies, each contributing to the future of digital finance.
Part 9.
As we reach the end of our exploration, let's recap the significance of BlackRock's groundbreaking $1 billion investment in Bitcoin. This monumental move by one of the world's largest asset managers represents a pivotal moment in the evolution of both cryptocurrency and traditional finance. BlackRock's decision to invest such a substantial sum in Bitcoin underscores a profound shift in the financial landscape. It signals a growing acceptance of digital assets as legitimate components of a diversified investment portfolio. This landmark investment not only enhances Bitcoin's credibility but also suggests that cryptocurrencies are moving closer to mainstream integration. The endorsement from a financial powerhouse like BlackRock lends considerable weight to Bitcoin's role as an asset class, potentially influencing other major institutions to follow suit. This development is more than just a financial transaction, it's a statement about the future of investing. BlackRock's involvement could pave the way for increased institutional participation in the cryptocurrency market, driving innovations, and contributing to the evolution of financial products. With clearer regulatory frameworks on the horizon, the path is being set for cryptocurrencies to become a more integrated and stable part of the global financial system. Looking ahead, the impact of BlackRock's investment on traditional investment strategies cannot be overstated. Investors will need to reconsider their portfolios in light of these developments, evaluating how digital assets fit into their long-term financial goals. As Bitcoin becomes more established, it could play a significant role in portfolio diversification, offering a hedge against traditional market risks and opening new avenues for growth. For those who are intrigued by the potential of cryptocurrencies, now is an opportune moment to delve deeper into this evolving space. Whether you're a seasoned investor or someone just beginning to explore the world of digital assets, BlackRock's move serves as a powerful reminder of the opportunities that lie ahead. It's crucial to stay informed and carefully assess your investment strategy in the context of these developments. In light of BlackRock's substantial commitment, I encourage you to consider how cryptocurrencies might fit into your own investment strategy. Take the time to research and understand the implications of such investments, and explore how they might align with your financial objectives. As the landscape of finance continues to transform, staying informed and proactive will be key to navigating these changes successfully. BlackRock's $1 billion investment in Bitcoin marks a significant milestone in the journey of digital assets. It not only highlights Bitcoin's growing legitimacy but also foreshadows a future where cryptocurrencies play a more prominent role in the financial world. As we move forward, the intersection of traditional finance and digital assets will continue to evolve, offering new opportunities and challenges for investors. Embrace the changes, stay curious, and keep exploring the potential of this exciting frontier in finance.
Part 10.
If you found our discussion on BlackRock's investment in Bitcoin insightful, we'd greatly appreciate your support. Please like, share, and subscribe to our channel. Your engagement helps us continue to deliver valuable content on key financial topics like this and beyond. We also invite you to join us on our livestream, Intrusive Thoughts Live, where we delve into a wide range of subjects and interact with viewers in real time. It's an excellent opportunity to be part of the conversation, ask questions, and engage directly with us. We'd love to hear from you, so don't hesitate to leave a comment below. Share your thoughts on BlackRock's investment, your perspectives on Bitcoin and other cryptocurrencies, or any questions you might have. Your feedback is crucial and helps us refine our content. For more insights into Bitcoin, cryptocurrencies, and related financial trends, be sure to explore our other videos. They provide additional information and strategies to help you stay informed about the rapidly evolving financial landscape.
Thank you so much for watching. If you enjoyed this video, make sure to check out the rest of my channel for more great content. Don't forget to like, subscribe, and hit the bell icon so you never miss an update. Your support means the world to me. See you in the next video.